more green generation. Where we need the federal support in the utility industry is actually for more transmission. But both will be helpful, and we see both of them happening. So we're actually very excited about the relatively new administration.
Okay, John, thanks for the thoughts here. Like the conversation and how to think about utilities even as rates continue to climb. Appreciate you being here with us. John Bartlett, president at Reeves Asset Management. Let's talk some stock moves when we come back. About 2.5 minutes from the opening bell, we'll take a look at Viacom, what the analysts are saying after the huge drop, the explosive move, and the owner of the Paramount streaming service. We'll talk Southwest and some orders for planes. That means Boeing's in the mix too. We'll be right back with upgrades, downgrades on Twitter and Baidu as well.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you an active trader? Our active trading webcast series is designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
"24/7 access to diverse global markets. Right here.
That's why I added stock index futures to my trading strategy. Now when I see ups and downs coming, I'm ready.
Well played."
What do you look for when you trade?
I want free access to research.
Yep, TD Ameritrade's got that.
Free access to every platform.
Yeah, that too.
I don't want any trade minimums.
Yeah, I totally agree. They don't have any of those.
I want to know what I'm paying up front.
Yes, absolutely.
Do you just say yes to everything?
Well, I say no to kale. Yeah, they say if you blanch it, it's better, but that seems like a lot of work.
Now offering 0 commissions on online trades. We charge you less, so you have more to invest.
Technical traders, the Chartmaster is in the building. Trends, support and resistance, key patterns, and technical indicators. The Chartmaster has your live technical analysis throughout the trading day, only on the TD Ameritrade Network.
Welcome back to Morning Trade Live. We've got stocks getting ready to open up with a little bit of red, but considerably better than where we were overnight and earlier in the very early morning. At one point, we had stocks down about 1% for the small caps in particular. Of course, the big headline over the weekend is the stress caused by a multi-billion, we're talking $20 billion liquidation from a hedge fund, Archegos Capital Management, run by Bill Hwang. The New York-based family office was slammed in long positions on companies like Viacom and Discovery, among others, forced to get out. Banks on the other side of a fairly opaque trade that has now caused some ripple effects as we've seen companies like Credit Suisse and Nomura warn of losses. Those stocks are down, and a few of our own banks here are as well. Let's bring in Jeff Pierce to help us through some of the movers this morning, our contributor here on the TD Ameritrade Network. So, Jeff, this morning, even without any clear direct relationship to this blow up, we've got Goldman, we've got JP Morgan down a little bit, down about 1% right now. But we also do have bonds a little bit firm. Viacom, though, is down only 1.5%. I think maybe it's best to start there, looking at Viacom and Baidu and how the analyst community is responding to this story, as everybody was looking for a reason, right, for why there were some extreme blow-ups last week, in particular Viacom. I mean, from $102 to 40 bucks at one point. So what are folks saying here this morning now that we know some details about who was behind this?
Well, the analysts are coming in, and I think maybe because their expectation is some of this volatility might have died down. You're right. Everyone's kind of been looking for what the reason was. Initially, people were thinking that for Viacom, and the company offered those 20 million shares of the Class B common stock. They did that a little bit lower than where the stock was trading. They thought that that might have gotten investors to trigger some of that sell-off. Now, obviously, we know more about it. But if we look at Viacom today, BMO Capital raised up their raised them to market perform, from underperform with a price target of $70. The analyst said it makes sense to get more proactive if the stock remains under pressure and heads below 35. While the scenario incorporates downward estimate revisions, said that the increasingly priced to the current share levels. Basically, what we've looked at here is a company that's had quite a bit of competition, but they've been creating competition on their own. They've been up. The stock has been up 242% going up to today. It dropped about 52% from the close of Monday to Friday. So analysts are coming in, and I think they're looking for a potential buy opportunity, especially if some of this volatility has died down.
Okay, now the catch is on the way up. There were also some pretty wild analyst revisions to the upside. It seems like the narrative maybe got away from itself as we were on the way up. The company pricing equity offerings last week, taking advantage of the run. It seems that even the company knew that this was getting a little bit, extreme, and being the stewards of the shares as they should be, took advantage of this by issuing more, which in part makes the price go down, but also kind of tells us that even though there's good things happening here, right? The Paramount Plus, obviously CBS Sports is a big part of this as well. It just seems like there was a lot that got pretty extreme. And then with this blow up, analysts saying, okay, go and buy it. I mean, I guess we'll test to see the appetite, down 3% right now. In the moves in the upgrades that you're seeing and the kind of support for the stock and the language from the sell side, are they addressing specifically this trader and saying, okay, now this is done, it's in the clear? I mean, how do we even know what this thing is supposed to be worth now if it could go from 40 to 100 and back to 40 all in the span of a couple months?
Right, that's a good question. No one has addressed it clearly to say, hey, this volatility is gone. We don't have to worry about this downside movement. I haven't read any stories to say that. I think what analysts are looking at now is if the stock is to get back on track or maybe even dip a little bit lower, they see a proactive move there to buy in. The analyst at BMO said that $3 billion in free cash flow for Viacom's streaming business and by 2030 is reasonable, given its library of content. So maybe if you're an investor that believes that $3 billion free cash flow is a reasonable estimate that they could get to, and this is a buying opportunity for you, then you would look to an analyst like this and maybe see if it's something that'll work for you. But I haven't seen anyone discuss yet that this volatility is gone, and I think, to your point, we've seen it to the upside almost just as much as we just saw it to the downside.
All right, apparently there's still some shares left to be sold as part of this big liquidation. Morgan Stanley reportedly looking to sell a large block of Viacom, and who knows where this drama ends. Obviously, this is a stock that's become more high risk probably than many maybe expected or were pricing in. Clearly, when you've got these types of moves, you're going to have volatility well bid in the stock as it is. So options have gotten a little bit more expensive, especially in the short term. Let's talk about Baidu. I mean, part of this too is big Chinese tech, Jeff, that had been pulling back really for more than a month for most of these stocks. Baidu is really the kind of a last standing big tech China play that was near highs, but Alibaba, Tencent, a lot of these have been rolling over since late last year or at least earlier this year. How does Baidu fit into this?
Yeah, sure. I mean, to your point, they're up 110% over 12 months going into today. They hit over $354 in February. The stock dropped about 20% from Tuesday last week to Friday last week. Analysts, kind of like we just talking about with Viacom, are starting to come in. An analyst from Loop upgraded Baidu to buy from hold, adjusted their price target to 290 from 210. He said, talked a lot more about just where the auto industry is going, talked about the drastic formation in the auto industry, their focus on car electrification, but also talked about 5G connectivity, autonomous driving, and really about where Baidu's business is in that race. Didn't speak a lot to what had recently happened with Baidu, but again, this is all coming from that same situation, as you pointed out, those large block of Baidu shares being sold as a spree of these Chinese technology giants, as well as the media conglomerates start to get sold off because of these issues. And again, this is really tied into the same situation as what we saw with Viacom.
Okay, so Baidu a little bit more stable this morning, and then I hear a little bit more of a fundamental case from this upgrade where, they're making the case for the cars, making the case for autonomous vehicles, the tech behind it, and basically just doubling down on a stock that had been a big winner, again, even beyond many of the other China tech plays where Baidu has really been the favorite as of late. Still, though, this analyst with the upgrade is saying that the price target, $290, still below the previous high by $60.
Sure, and I think that's what we're seeing here. And you had a great question earlier about what are they saying about the further volatility. There's not too much comment on it. It's back to what can these companies do, whether we're talking about Viacom and how their competitiveness with Paramount, whether we're talking about Baidu and their competitiveness in the autonomous driving world. They're setting their price targets, in this case a little bit lower than that high we saw, and they're talking about the actual company and what they can get done. They're not talking about just making a trade based on this volatility. So it'll be interesting to see how this plays out and whether or not some of this volatility continues, especially for Viacom, I would say.
Okay. All right, let's talk about a few other stories here as we speak, by the way. The NASDAQ goes positive as bonds flip negative. Something to keep an eye on for sure, to see that inverse relationship. It's something new. We'll see if it holds. We got a little bit of that on Friday, as obviously the NASDAQ had that big ramp. That would be very important and good for bulls if we see yields higher and the NASDAQ higher. So just a little bit of action this morning for the update. Let's keep going with some of the stocks. Jeff, Southwest, 100 orders for some Boeing planes. It seems like a pretty big story for Boeing.
Yeah, I would say it's a very big story for Boeing. I mean, they plan to convert about 70 of their orders for the MAX 8 to MAX 7s. They've also added about 155 options for the 737 MAX 8 planes or the MAX 7. The agreement takes Southwest order book to 200 for the 737s, 7s, and 180 for the MAX 8s. So more than 30 of which are going to be delivered by 2020. This brings their options up to 270 for either model, and a total commitment is around 600 planes. So, this is, I think, goes a long way for Boeing to see, or at least for investors to see, that some of the major airlines out there are starting to pick up orders again on these 737s.
That's a pretty big deal. I mean, 100 planes, Boeing shares up 3.3%. Stock is looking good. You got a reiteration of a rating from Goldman, right?
Yeah, Goldman reiterated. The analyst kept them in a buy with price target of $275. Talked a little bit more just about Boeing being able to resume these deliveries after the FAA completed their final pre-check. The analyst says that this is a significant milestone for the company. He believes the prices are moving into place for strong free cash recovery and a delivery of a balance sheet, a multi-year delivery growth for Boeing. So this is good news coming out of Southwest, also good news coming out of the analysts from Goldman Sachs, and I think investors are obviously reacting that way to Boeing.
Okay. Boeing has, I think, pretty powerful message from the chart here over the past year now. It's been a year since the lows in March. We've got higher highs. We've got higher lows. You've got pretty much everything you could want except for a return to pre-COVID levels. This is one that still is well below. I mean, you've now quadrupled off, almost, not quite. You've gone up a lot since the $89 low, but we are still below the $330 this thing traded at. It's been a lot of time around $330 for the year preceding COVID too. So I think that context is important, that maybe there's a little bit of a magnet around that $320 level, but then once we get there, perhaps things get more difficult.
Yeah, and I think from an investor standpoint, you're wondering what portion of this comeback, if you will, is getting over the 737 issues they've had versus coming out of COVID and seeing these planes start to take off and watching people travel more again. And So I think you could make the argument that they may be coming out of some of the 737 MAX issues with their price movement, and certainly these stories would help make that argument as well. But it'll be interesting to see because, of course, they've had both issues going on at the same time. So I think there may be potential for a longer recovery, especially as we watch the airlines start to take on more travelers.
Okay, so positive news with a recovery theme. Boeing getting orders, planes flying again. The travel numbers this weekend were some of the best that we've seen. I believe we are at the smallest gap between now and 2019 in terms of the amount of people flying. 1.36 million, according to Charlie Bolello from this weekend. The TSA checkpoint travel numbers, which was down about 43% from 2019 levels. So we continue to close that gap. And that's showing up through the stories here as well that are very specific, fundamental, and are giving us real evidence of actual orders taking place. This is not just looking at a number and saying, oh, well, people are traveling, things must be getting better. It's already making its way down on a pretty specific micro level.
Sure, and those TSA numbers, we've seen them. They've been climbing now recently, and that's great news to see. Of course, we know one of the larger concerns in the airlines is going to be that business travel expectations, or that's going to take quite a bit longer to come back. But I think as we see the vaccine roll out, as we see the economy reopen, maybe a little bit faster. I think you could argue certainly faster than what was expected in the previous months. This is starting to show up in the travel, and these TSA numbers are a good representation of that.
Okay. Hey, Jeff, one more here this morning on the move. Pretty nice pop, 5.5%. Twitter is back, bouncing at $60 after a pretty deep sell-off from $80. Dropped about 25% down to the low of about $59.80 where we left it on Friday, but it's waking up today on an upgrade. What's it say?
Yeah, hit that 80 back in February, but analyst at Truist upgraded Twitter to buy from hold with the price target of $74, up from $64. The analysts cited their tangible progress in its products as well as their greater traction with their users. Really noted their double-digit growth for monetizable daily active users along with their more attractive valuation, and basically talking about that price drop there, right? So, this is a company that says that they plan to double their annual revenue by 2023. They plan to attain 315 million monetizable daily active users over the same period. They also plan to double their development velocity by the end of 2023. So if you think those things are true, then seeing this drop that we've seen since February might be really catching your eye.
Okay. All right. So an analyst who is not convinced, now convinced, pushing up the price target, saying to buy it. And Twitter, which is really on the move. We'll see what kind of follow through it has. The stock was explosive as they continue to give better than expected updates and forecasts, gapping higher basically from the start of 2021 all the way through the highs at the end of February. So we'll see what kind of excitement can come back into this leader. Thanks to Jeff Pierce for the movers this morning. Twitter right now up 4%. Stocks also stabilizing. We've got the Dow flirting with positive. The NASDAQ was there for a second, then slipped back down. Staples, materials, industrials up front. Energy is down as crude oil rolls over. They got the ship out of the Suez Canal. It's on the move. The Ever Given is out. And crude apparently giving back some of its recent gains as a result.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The Platform Demo webcast series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate TDAmeritrade.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Feel that? That's the beat of global markets, the rhythm of the world. But to us, it's the pace of tomorrow. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. NASDAQ. Rewrite tomorrow.
I added futures to my trading strategy. Now, I have 24/7 access to diverse global markets, including crude oil. Like I always say, leave no opportunity untapped. I'll just sign that. Yeah, got it.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Evelyn Baker here with a few stories making headlines this hour. Shares of Tencent Music are up 3% after the company announced a $1 billion share buyback plan. This is the Shenzhen-based company's largest buyback program to date and comes following a sharp sell-off in the shares. Since the company reported fourth quarter results on March 22nd, the stock has fallen roughly $12, which is more than 35%. On the vaccine front, Johnson & Johnson will provide up to 220 million doses of its COVID-19 vaccine to the African Vaccine Acquisition Trust, or AVAT. The company's Janssen Pharmaceutical segment has agreed to deliver the doses to the African Union's 55 member states beginning in its third quarter. And AVAT also has the potential to order an additional 180 million doses for a combined 400 million through 2022. And shares of Accenture are down 0.5% following news that it's agreed to acquire the company Signy, which is a full-stack development firm that will help Accenture drive its cloud and technology innovation needs. The financial terms of the deal haven't been disclosed yet. Additionally, this morning, Accenture secured a $453 million contract with the U.S. Department of Veterans Affairs to modernize and improve GI Bill claims processing for veterans. This has been your TD Ameritrade Network Market Update. Now back to Morning Trade Live with Oliver Rennick.
Welcome back to Morning Trade Live. It's time to talk some fundamentals on stock picks and trade. Joining us to talk some small caps and overlooked companies, Nancy Pryl is the co-CEO and senior portfolio manager at Essex Investment Management. Nancy, it's always good to get your takes here. Welcome back.
Thank you. Thank you for having me back.
I want to jump into a company that stands out to me on the list of stocks you like right now. This is an autos and tech play where many have been focused on chip makers and the automakers themselves. You've got a company called Visteon Corp. Tell us what they do.
Yeah, so Visteon Corp, as you mentioned, it's an automobile supplier. They currently sell infotainment systems into many of the major automobile companies. And we like that business as a standalone business. Infotainment is gaining market share, moving down into lower-end cars, and they continue to gain among the major OEMs, both in the United States and abroad. What we think makes the stock even more intriguing now, though, is that they have a window into the EV space. So they've signed their first contract with General Motors, where they have a wireless battery charging system to go into the car. They estimate that GM alone could account for 7 to 9% of revenues over the next 5 to 7 years as GM rolls out their EV platform. And of course, they're also in conversation with the other major OEMs, all of whom are coming out with very strong EV platforms with the hope to gain market share in this very, very exciting, disruptive industry.
It seems like a supplier of critical technology for tech-heavy vehicles should be doing something similar on its chart next to the electric vehicle makers or the car makers, even the traditional car makers themselves. Yet the stock is trading where it was in the summer of 2018. What's going on? How come this is compressed in its valuation compared to some of its peers in the space?
Well, we think there are two things going on that account for that. One is that for the last couple of years, there had been a thesis that perhaps millennials and Gen Zs would not buy automobiles like older generations have done. Now, we think that thesis has changed with the onset of the pandemic. We actually always expected it to change as millennials and Gen Zs had children and realized that ride sharing was perhaps not as convenient when one had a car seat and things like that. That you needed to snap into your car, but particularly with the pandemic and people working where they live and living where they want to live instead of where they have to live, that automobile sales are going up. In addition, the market has been very excited about the pure play automobile and truck makers in the EV space and have not yet turned their focus into those companies that perhaps are further down in the value chain, but that will be very big players. That creates the opportunity to buy a company that is going to have what we think is very strong, very good growth with very positive cash flow that will be a backdoor play as a supplier into this explosive growth industry with actually less risk than you would get by playing the actual manufacturers of the cars and the trucks, where we don't know yet who will gain share and who will not gain share. This way we get exposure on a broad swath of companies, some of whom will gain share, but not all of whom will.
Interesting. Okay. I like this one. There's a few other ones that I want to get to before we start trading these. Nancy, ICHR, Ichor, this is basically a semiconductor play and that was trying to contribute to solving some of the supply chain issues?
Exactly. So we have had a thesis for a number of years about the reshoring of manufacturing in America. Obviously, this is another issue that became very important in the pandemic as we realized the strain to our supply chains with our dependence on manufacturing overseas. And certainly President Biden has been talking very much about the need to move manufacturing back to the United States, in particular semiconductor manufacturing, where semiconductors are such a crucial building block today for so many industries, including, as we just talked about, the automobile industry. Ichor is in the wafer fab equipment side, so that means they're on the front end of semiconductor manufacturing. They supply their products into companies like Applied Materials, Lam Research, the leading players in wafer fab equipment. This is an extraordinarily cheap stock, selling at less than 14 times earnings. It is a cyclical industry, but we are in the beginning of what we think is going to be a super cycle of growth, both driven by the increased penetration of semiconductors into many industries, as well as by this reshoring plan. As I'm sure you know, Intel last week or 2 weeks ago announced, I think it was $20 billion in capital spending to build 2 manufacturing facilities in Arizona. We think that is not the end of companies, both U.S. and foreign companies, building new plants in the United States.
Love this pick, super interesting, definitely overlooked, and a semiconductor right now that's making highs alongside some of the manufacturing and fab makers, as you mentioned, Applied Materials and others, where we've seen this industry really separate winners and losers in this specific environment. Seems like Ichor is in the winning category right now. Nancy, real quick, last one, Domo, a stock that I think some will be familiar with in the software space. Why do you like it right now in a period where a lot of investors are retooling some of the expectations post-quarantine for software plays?
Right. And we think that that is still going to continue. But Domo is both an attractively valued stock within the software space, as well as a really interesting opportunity to participate in the democratization of business intelligence and analytical software. So until now, most of this, what they call BI, business intelligence and analytical software, has really been controlled by those experts who know how to use very complicated software. Domo is pushing that down into the lower ranks within companies so that anybody will be able to do their own analytics using the Domo software. They are partnered with firms like Snowflake and Amazon Web Services. So we know there's been a lot of excitement over Snowflake after they came public. Amazon Web Services has been a terrific growth story for Amazon over the last couple of years. Here again is a backdoor way to both benefit from some of their growth as well as from the growth inherent in Domo themselves. We think they can continue to grow their top line at a minimum of 20%. This is an industry that is very early on in its infancy, in its growth, And as you know, the need for analytical software and the proliferation of data is doing nothing but increasing.
Nancy, we could keep going. I love talking stocks with you. Thanks so much for joining. We got to trade him down, though. Appreciate it. Nancy Prowl, great stuff. Let's bring in Alex Coffey. Okay, Alex, we're going to go to Domo, but let's first go to VC. The one that we heard here is the autos play from Nancy. How would you trade this bullish?
Well, the one thing I would say is that these stocks, both the charts look a lot like most of the tech stocks that we've seen, Oliver. You've seen extraordinary runs, some pullbacks here. But when you're looking at VC in particular, Oliver, you're going to notice a $120 price tag. So while it's not the most liquid name in terms of the options on the street, it's quite expensive to go out there and buy shares. It's certainly still a viable strategy for those with high conviction in a name after they hear the thoughts from Nancy. If they want to go out and buy shares, always a viable strategy. But for those who want to go to the options market, they want to control the risk a little bit more, be a little bit more strategic. The long call diagonal, or as Tom White often refers to it as, the stock replacement strategy would be one to consider. In this case, we're going to buy a June call, the 110 call. So it's going to be in the money. That's going to reflect our stock kind of piece of the of this position. It's going to have a bigger delta. It's got a little bit longer dated expiration, so that time decay is going to work against us a little bit less. To make this a little bit more strategic and also chip away at this pretty hefty debit that you're going to see on that call, we're going to sell a more near-term call. In this case, we're going to go out to April, and we're going to sell the 130 call. This creates the diagonal spread, and this allows us to be a little bit more strategic with this position while giving up some of the possible upside. In this case, a 1470 debit as the overall spread. Whatever we fill this as, that's the overall risk. So for a one lot, Oliver, 1470 is $1,470 worth of risk in US dollars. Typically with these strategies, and you're going to notice there's one more expiration between our June expiration and our April expiration that we've sold that option in. You would, if the secondary market allowed for it to be the case, if it hung out around here, there was still premium in those May options, we would likely look to at some point buy back our short calls in April and sell some out in May, do what that we refer to in the industry as rolling that trade to continue to chip away at the debit. But all things considered, if you just put this one on, set it and forget it, break even 124.70. So you need about a $4 move to break even in the June expiration. But all in all, this is a bullish trade, takes a little bit advantage of time decay, but it allows us to control the risk while also being a little bit more capital efficient, because to go out and buy 100 shares of stock, Oliver, that's going to be $12,000. This trade, we're able to do it for just under $1,500.
Okay. All right. So looking to finance a little bit of this, at least in part, through the diagonal and getting the long exposure. Let's go to Domo, the software play. You've got a different way to approach this one, Alex.
Yeah, and so this is a strategy that if you're ever considering to accumulate shares in a name, you like a name bullishly, but in a way you're not so sure maybe about where the entry point might be, or if you're going to have an opportunity at some point to buy it lower and you're kind of on the fence, selling the cash secured put, which is the example trade we're presenting here in Domo, is a way to kind of pick a spot that you're interested in potentially becoming a long shareholder in. Do so in a way that's going to take advantage of time decay, but more importantly, it allows us to pay to wait for, or get paid to wait for that price. And so we never know if Domo will trade down. It's down a little bit today, $3.61, but what we're looking at here is selling the 55 put. And so in this case, Oliver, with the stock being lower, you're actually seeing this put trade for quite a substantial premium to where I was looking at it earlier. You may even consider moving this down to the 50 strike and trying to get a comparable amount. But in this case, if you like the 55 level, right now the midpoint actually is ticked up to 470. So in this case, you're going to see a $1.30 premium to even where I was looking at it just earlier. But this allows us to get paid to wait. If the stock sells off below 55, we'd potentially face assignment of those shares. But if it does not at expiration, we would keep the credit received and we would move on. So in this case, using the numbers that we had, break even was 51.60. That was the 55 net of the 340. It would be a little bit better now, closer to $5 or $50.70. The max loss on this trade, well, you just take that break-even price times it by 100. So in this case, with the example that we were looking at, 5,160. That's only going to take place, though, Oliver, if this goes all the way to zero.
Right, it's got to get slammed.
you breach the short strike, Oliver, it just performs like stock to that extent because potentially you'd just be facing assignment of the names. But this is a strategy that I would always consider if I was ever considering buying 100 shares of a name, because it's a great way to be a little bit more strategic while accumulating those shares.
Got it. All right. So not looking for the same type of upside, but still obviously one that has that intent to be long one way or another, right? You either get paid because it doesn't drop, or you get ready to buy them and take it for the price if it does move against you. Okay, Alex, thanks for the implementation here, the picks from Nancy. Good stuff. Mr. Coffey, thank you. When we come back, hour 2 of the show, equities are buckling, but the narrative sure has flipped here. Even as we see that story from over the weekend on the liquidations, that didn't really cause much of a flare-up. But guess who's back? The U.S. Treasury market this morning. Its 10-year yields going a little bit of a spike higher. Gold getting slammed as real yields climb. The NASDAQ now the worst performer, down 90 bips. Tried to move higher, but as bonds dropped, it's pulling tech with it still.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The Platform Demo webcast series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate TDAmeritrade.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today. Technical traders, the Chartmaster is in the building. Trends, support and resistance, key patterns, and technical indicators. The Chartmaster has your live technical analysis throughout the trading day, only on the TD Ameritrade network.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on Thinkorswim for the full Options for Volatility course and a whole lot more.
Welcome back to Morning Trade Live. I'm Oliver Rennick. We're in hour 2 of the show here. 30 minutes into the trading session, stock still under pressure, but a little bit of a different wrinkle arising since the open. That is a jump in the 10-year yield. It's back. The bond market causing a little bit of issues. Once again, as soon as yields started spiking, NASDAQ took another leg lower. Now we're down about 1% in the Qs, so we're watching that relationship once again. The most important thing here, I have to stay focused on the bond market. Facebook, price target hike, we'll talk about it. Alan Uckman's going to trade Oracle. Heard the case from some analysts on why the stock is poised to outperform its tech peers in a return to work and office environment. We're going to talk some home markets as well. Home builders and the home buyers who are causing the big rip in demand that has been outstripping supply. We'll check in with some charts from Tian Liu of Genworth Mortgage. Always a really good conversation. Don't miss that one as they look at the data on who's buying the homes. Chartmaster has a few other analyst reports for us. We're going to take a look at a few retail plays and a couple reopening themes as well. Let's go to Ben Lichtenstein, host of Futures and Midday Movers. Hey, Ben, the ship, they got it out, right?
The ship has sailed, Oliver, so to say.
The ship has sailed.
Yes, crude oil actually right now coming off a little bit, down by about 1.25%, but not really responding too much to the news. We saw it sell off this morning for around 61.60. And as you take a look at the 5-minute chart here, you're going to see kind of a limited reaction to, again, news that this cargo vessel, the ship that had been blocking the Suez Canal, which, well, earlier this morning had been partially floated after they removed something like 30 metric tons of sand. Oliver, it has been, or it's once again on its way through the canal, and ultimately this frees up the blockage that's been caused. Something like 450 ships, almost 500 ships now waiting to pass, Oliver. It's forced some to take that longer, more expensive, more treacherous route around the tip of Africa. This we're talking about is a shipping lane which covers about 10% of seaborne, 12% of seaborne trade, so something to watch. This is a 5-minute time frame. You can see not a lot of reaction to in terms of movement here, Oliver, but if you take a step back from that 5-minute, if you take a step back and look at the daily time frame, you'll see that some of the weakness we saw in crude recently brought us back down to the 50-day moving average. The news of this ship blocking the canal and ultimately tankers being held up, that actually helped support prices. Keep in mind, this is with a dollar that's been strengthening as well. And one of the real reasons we look at crude prices is ultimately when you have a fundamental kind of disruption like this, it sort of derails or kind of takes away some of this correlation that we look at in terms of the ES and crude. But the reason everybody's been kind of focused on crude is because, Oliver, as you can see here in the purple line, crude recently spiked up into the $68 level and really kind of fizzled out. This coincides with the indices sort of losing some of the momentum to the upside. And again, with two products that track each other very closely, you can see why investors and traders are keeping a close eye on what's playing out here, not only in terms of the ship, this vessel, but also crude prices in reaction to.
You know, I like the 50-day moving average chart, if we can go back to that for a sec, because it kind of just dampens some of the drama a little bit into something that suggests maybe crude got a little bit ahead of some of the momentum from even a very bullish trend, right, where we've been continuing to rally crude ever since negative prints and all that weird stuff back in the quarantine period. But in the context of the 50-day moving average, that push past 60 maybe was just a little bit too much, and now we're back trading around that level that could just continue to grind its way higher. So maybe some of that short-term kind of froth that got into the crude market when we blew past 60 with no problem, maybe that was a little overdone, and now we're just continuing on at a more reasonable pace, Ben.
Yeah, it is, Oliver. I think what's playing out here is definitely a bit of frothy type price activity up into the 68 level. And then, you know, we had some of the, key agencies. We're talking the IEA, which had shot that down. They said, hey, this expectations for this commodity super cycle, they didn't really support it or feed into it. But, right. Oliver, I do want to talk about, as we move away from crude oil, another commodity market that's on the move and attracting some attention today. Yeah, taking a hit. Look at the move lower here, down to the 1705 level. Now, 1700 is a key psychological area to watch, but I think more importantly than that, I think you have the lows down that we recently saw down at March around 1673. So you can see how gold right now, for the most part, is really just in the middle of the range that we've been in throughout the month of March. We have a high up around 1757, a low of 1673.30. But Oliver, ultimately, gold I think should be watched here. If we do take out those most recent lows that we saw back in the beginning of March, we'll be talking about levels we haven't seen since, again, you're going back to the spring of last year and the recent run-up that we saw up and through 1600. So something to watch here. I think this is directly tied to rates. We're watching treasuries on the move today as well. And also, interestingly enough, you've got to point out that inverse correlation that we've seen gold and Bitcoin playing out over the last, really well-defined over the last year or so, or this year, and certainly over the last few months. Here again, we've got a situation where Bitcoin's been rocking to the upside as we looked at earlier in the show, but here you can see people are selling gold coins to buy Bitcoin, it appears.
Yeah, Ben, we've also got bonds getting hit. It just kind of came out of nowhere this morning as I think that this kind of risk-off bid, we saw that early push into the bond market. But as we talked about, it was barely even anything. And then, bam, just gives it right back up. Seems like the bond market here is really going to have trouble finding buyers given the anxiety coming into the market this morning. Yields are spiking anyway, and they spiked last Friday even as PCE came in soft, Ben. What else is it going to take for people to realize that this yield is going one way?
Well, Oliver, I think that risk-off trade that we had been seeing in months past is just non-existent at this point. We've been talking about Bitcoin on the move higher, gold on the move lower, the dollar inching its way up. But let's talk a little bit about the Japanese yen. Oftentimes oftentimes equated with that risk-on type sentiment. You'd expect to see bonds to the upside amidst some of that fear, concern, but even with the indices at all-time highs here, Oliver, there is very little fear in this market right now, and I think that's what you're seeing here in terms of the yen, in terms of gold. These two products, the yen and gold, have been tracking each other very closely since the beginning of the year. A lot of weakness. And I do want to point out here, Oliver, that we've got Bitcoin back down to levels here, or I'm sorry, yen, I should say, back down to levels that we haven't seen already to those lows that we were talking about in terms of gold, the spring of 2020 last year. So keep an eye on this move lower in terms of gold. I think if the yen is telling us anything, there could be more downside here.
Okay. All right. Thanks, Ben. All right. Appreciate it. Interesting stuff. We got a little bit of cross currents in the market this morning. Pat Mullally is joining us from our Salt Lake team for a few stock moves. We're going to talk some tech here. First, social media, and then some bigger themes in tech for the reopening side with Oracle in a moment. Pat, Facebook's got a price target hike this morning. Deutsche Bank still says to buy it. It had been one of the better performing FANG stocks this morning. It's up 1%. What are we looking at?
Well, I think we're looking at three different types of momentum that are positive for Facebook right now. And the first one would be that the sentiment that we're hearing out of the analysts. So Deutsche Bank, of course, raising their target to 385. Most analysts have had a strong buy. And the technical targets that we've seen are, bringing us, the lowest of those, bringing us to about 350. Now you can see that technical target has been raised, or the analyst target has been raised at 385. So I'm imagining that they're going to see a lot of follow-up with